Welcome everybody to the Family Office Forum session on venture capital.
Yes.
As it was just announced, my name is Kamuti Kiteme. I'm going to be your host for the next 50 some odd minutes. Before we get to introductions, I'll kick it off just by saying our topic for discussion, which will attempt to guide us as we have this casual conversation, will be venture capital trends for 2021 and beyond. So it's a kind of larger topic, so we'll have a lot of room to kind of move around and kind of see where the conversation takes us. Before we introduce the participants, I want to emphasize that we encourage questions and feedbacks from the audience. You should be able to message us through the chat function, and more importantly, I'd like to encourage a spirited conversation. All the participants can share their perspectives, even if I'm not asking you the question, but feel free to jump in. We got a lot of meaty topics here. So why don't we start with, I'll call your name, participants, and you'll do a quick introduction of yourself and your firm, take about up to a minute to give us some background, and we'll kind of go around the horn. Maureen, do you want to start?
Sure. Well, thanks again for having me, Marty, and including me. I appreciate it. My name is Maureen Downey, and I'm a managing director, and I work for a company called Beneficient Group. And Beneficient is a fintech platform that aims to provide liquidity for currently a pretty unmet sector of the market, which is high net worth, ultra high net worth family offices to some extent, and small to medium sized institutions. And I can elaborate on that a bit more, and doing it in a more of a process way, data driven, to come up and produce liquidity within 30 days. Normally, transactions in the secondary market take anywhere from 4 months to 18 months. I have spent many years doing it across the board on all types of alternative assets. My background has been in private equity for the past 15 years, and before that, I was an investment banker and have worked in Europe, US, and Latin America.
Great, thank you, Maureen. Let's go on to Nuno. Are you here on the call? There you are. I think you're...
Yes, I am. I am Nunu, though.
Oh, Nuno.
It's a Portuguese name. Yes.
Okay, sorry.
Nunu.
Sorry, Nunu.
Yeah. Like
and I
Lulu
apologize
with
if apologize if I butcher anybody's name, because my name gets butchered all the time. So apologies.
And is it Kamuti?
Yes, it is. Thank you.
Kamuti. Okay, very
Thank
good.
You,
awesome. So I'm the managing partner and founder at Chamaeleon. This is my third fund in venture capital, but it's a new firm. Very much the thesis is not only were people augmented, we have an incredible network of people that work with us as advisors, executives and residents, et cetera, but we're also technology augmented, which is pretty unique for early stage VC firms. We focus mostly on Series C, Series A, multi-geo based here in the Bay Area, but with an office in Europe as well. I personally have focused the last 11 years of my venture capital career in consumer, both hardware and software, as well as horizontal software as a service, and consumerized enterprise. Some notable investments would be companies like Downey, Rubrik, Gusto, and on the consumer side, companies like Robinhood, DraftKings, and Verta Health, to name just a few. I've been in tech for the last 25 years, computer engineer and product manager at the beginning of my career. Growth operator around strategy, corporate development, business development, and product strategy. In the middle of my career, a bit of a stint with McKinsey & Company after being their client for 6 years as a senior expert. And then in venture capital, because I'm a masochist, creating my own venture capital firm, Strive Capital, and now Chamaeleon.
Great. And pronounce your name one more time for everybody.
It's Nunu, like Lulu with N. Yeah.
Perfect. Nunu. Okay. Thank you very much. Chris, why don't we move on to you?
Hi, we're sort of hot swapping back and forth here. Hope nobody minds too much.
Okay, that's fine.
So that's why I suddenly popped into the picture. So I'm Chris Ye, and most people know me as the co-author of Blitzscaling, which is a book I wrote with my good friend Reid Hoffman. Thank you. I see there's some fans in the room. Awesome. And I also started a company called Blitzscaling Ventures, and Reid is an investor and advisor to the firm. And what we do is very straightforward. We monitor the top 35 VC firms in the world, look at every single one of their deals, pick out the ones that we think have the greatest chance to become $100 billion outcomes, and then I develop a relationship with the CEOs and get into the deals that way. So our business is accessing deals that nobody else can from the top venture capitalists in the world. And that's why I'm probably here on this panel today, because we monitor the activity of those top VC firms very closely. And we're seeing a lot of interesting things happening in 2021. We do have a $30 million fund. We're about $23 million of the way there. We mainly raise money from high net worth individuals and family offices. We have a lot of cool, interesting entrepreneurs from companies like DoorDash and DraftKings, and of course, Reed, and just very glad to be here today.
Wonderful. Thanks very much, Chris. Bryn, am I pronouncing your name correctly?
You are, well done.
Okay.
This is the panel of game challenges, I guess. So I am Brynne Kennedy, and I am a general partner at a new fund called BCP Blitz. We're a smart society venture capital fund. So I spent the last 2 years running for Congress in a district that was heavily oriented toward the opposite party. And I can tell you that everything is even more dysfunctional under the hood than it looks like on TV or your Facebook feed. So I decided after a lot of reflection that the way to solve the biggest problems our society faces is by bringing private capital with great entrepreneurs to build great companies. So that's what we do at BCP Blitz. We're raising a $100 million fund right now, and we invest in 4 problems: human wellness, climate change and environment, food and ag tech, and smart cities, how we move, live, work, consume, and pay in ways that are radically more efficient for all of us. So thank you so much, Marty, for having us all here today and on Zoom, and looking forward to talking about what we're seeing out there.
Great. Thanks, Bryn. Andrew, why don't you clean up for us and jump in there?
Yeah, great, thanks. So my name's Andrew Haughian with Pangaea Ventures. So we're a firm that's actually been around for about 20 years. I've been with Pangaea for 15. So one of the general partners here. We invest at the intersection of hard tech. So think companies that are leveraging materials, chemistry, biochemistry, sort of hard science, to solve the world's biggest, most important problem. So you could think of us as sort of an impact investor. Think climate change, decarbonization, food, agriculture, health. And yeah, we've recently had some sort of big exits announced, and we're also raising another new fund.
Great, thanks, Andrew. And I'm your moderator again, Kamuti. I am a partner at Akili Ventures. I've been working with VC-funded high-growth tech companies for 25 plus years across multiple different categories, and just now recently am working in Africa in the frontier space. I'm a dual citizen who got educated in the US and has decided to take all those learnings in tech to bring them to the continent, where I have family and obviously a lot at stake and a lot of investment in. And Akili Ventures is a holdco that both builds, operates, and invests in high growth tech startups. Okay, so let's start out with the first question, shall we? Chris, I'm going to start with you, if that's okay with you.
No problem.
Yeah, you brought up what I think might be one of the more dominant trends in venture capital and may represent the changing of the guard, I'd like to think. You said VC is no longer the province of VCs. What did you mean by that, and what are you seeing?
Sure. So I think everyone is probably seeing the same things that I'm seeing out there, which is that we see a lot of non-VC players come into the startup financing game. And obviously, we just had some discussions of blockchain and DeFi. Obviously, that's one way that things are being financed. But we also see lots of corporate players coming in. We see corporate players that have established venture arms and other corporate players that are just doing straight direct investments off their balance sheet. We see a lot of the traditional public market investors, hedge funds, mutual funds, and all sorts of other companies starting to get into the VC sector. And that's largely because companies are taking longer than ever to go public. Nowadays, I just saw there was an announcement Wesley Chan was posting on LinkedIn saying Canva just raised money at a $40 billion valuation. Well, before the past 5 years, was there ever a time when there'd be a $40 billion privately held company? No, it wouldn't happen, right? The gains would occur when the company went public at 1 or 2 billion, and then public market investors would write it up. So in search of returns, people are going earlier and earlier. And the biggest change is probably as a result of this, things like the Tiger Global phenomenon. So I don't know how familiar folks are with what Tiger Global is doing right now.
Yeah.
So Tiger Global, what they've done is they have taken an approach where they've decided venture capital is a commodity. And what they're going to do is they're going to raise money, several $1 billion a year in various funds. They're on fund 14 or 15 now. I think it's 15. And they deploy capital extremely rapidly into companies that they have already identified as being companies they want to invest in. So when they go to the founder, they don't ask the founder, hey, tell us about your company. They say instead, we'd like to give you $100 million at a valuation 5 times what your previous valuation was. We won't take a board seat and we won't tell you what to do. Are you interested? And as a result, these companies are raising large amounts of money. I believe that Tiger Global is actually doing something on the order of 10 deals a month with 2 investment professionals. And it's completely changing things. Now, the big question is, how do we react to this, right? Well, if you're a family office investor and you're thinking about this, clearly one of the big things is I need to get in before these players do. Because what's happening is these players are coming in and driving up the prices. If I don't want to pay those prices, I need to get in slightly earlier. I need to be able to have access to these deals before the Tiger Globals come along, before the corporates come along. And I think the implication for venture capitalists is you need to have some sort of distinctive value add, because if everyone's roaming around offering checks, you have to build your relationships with the entrepreneurs earlier, and you have to be able to argue for why the entrepreneurs should pick you. It is a buyer's market for money, which means that the entrepreneurs of the companies that are hot have enormous power to choose their syndicates. So as an investor, your goal should be figure out what is the reason why the entrepreneurs are going to choose me for their syndicate.
Maybe if I can step in, because I think I agree with the symptoms. I'm not sure I agree fully with the illness, because I think there's 2 illnesses in this case. One is there are some structural changes to how venture capital is done. There are very large players that have a lot of assets under management, hedge funds, players like Tiger Global that are coming from the private equity space. I would say actually the hedge funds are probably even more structurally interesting at the stage. Guys like Point72 with Point72 Ventures, Koa2 Management having come into growth and now doing ventures as well. And the reason why I think they're more structural is they have a different approach, because they have a lot of assets under management. They're trying to, at least slowly bring their own technology stacks to earlier stage, which is something we've been doing for 11 years. So I'm very passionate about that. And in that sense, I feel that change is here to stay. So that part, I think, is a part that I would fully agree with Chris. The other part is, let's be very careful with the rest. We're in the midst of a significant bubble. And that bubble, either we're going to have a soft landing or a hard landing, nobody really knows. But that bubble is being fueled by public equities, and it's also being fueled in private equities. And what that means is we have a lot of players right now that are very actively and aggressively investing in earlier stage that look like structural players in the market, but they might actually be tourists, right? I remember JP Morgan used to have a VC fund back in the day in the late 90s and early 2000s, right? When we had the last big bubble in tech, right? So in effect, I would just be a little bit careful in untangling what's happening. We basically value ourselves in being disciplined. One of the things that we as a partnership always discuss is, are we being disciplined? Is this the right valuation for this company at this stage? Have we done the right amount of due diligence? Have we done more due diligence than the others? So for me, going back to a point that Chris mentioned, which I think is actually very important, is what's our value add to entrepreneurs? I think it's more than that. It's what our value add to entrepreneurs and what's our value add to LPs. We're looking for LPs. We are already deploying capital. We've done our first close. We're doing stuff. We haven't really decided if we're going to do 2 closes, 3 closes, just the 1 close we've already done. But one thing we've decided is we want people that are going to stick around, right? We don't want corporations that are going to change the way to do things. We don't want family offices that are going through a dramatic transition right now, right? Ideally, a family office that has professionals attached to them. So for me, the key piece of what's happening right now is there's still a lot of stuff that's going to change in venture capital, but we have to be careful in taking out the capital part of the equation out of this and just really addressing the piece that I do think is structural, is VC needs to be innovated. Early stage venture capital, for example, just to give 2 examples that I think are very appropriate, does very little market analysis and scanning. Now that's mind-boggling to me, because even though you're investing in a very early stage company that might be pre-product or pre-launch, you still can analyze their market. You still can do outside-in analysis, right? And if you don't do that, either you're lazy or you don't have enough assets under management to hire people, but you should do that. The second analogy is actually, although there's been a lot of innovation around what I would say post-investment management, high assets under management like Andreessen Norwich and other firms have put a lot of capital into shared services. Actually, there hasn't been a ton of innovation on picking, which is where most of the value is created, where you choose the company, you invest in it, right? There hasn't been a lot. There's very few firms that are like our firm doing actually quant modeling, right? That actually have technology teams in-house that help them develop analytics engines. You know, there's maybe Signal Fire, there's maybe, you know, Koa2 doing some cool stuff on the early stage equity ventures. There's maybe 10 or 15 firms that you could name that are doing this in early stage. That I think is the structural change that we're going to have.
This is Bryn. The other thing that I would say is, you know, I look at it a little bit differently. I look at it as almost a Wall Streetification of venture. I personally don't think that's a good thing, right? There's so much money that's flooding into the market, so many new players, so many new people raising funds who, quite frankly, many of them have never even worked at a company, let alone been a founder and a CEO. One of the reasons that I decided with my partners to start yet another venture fund, and people often say, you know, oh, there's so many funds in the market, why would you raise another one? Is because operators solve problems that Wall Street people get freaked out about. I had some of those people on my board. And I think when you're an entrepreneur, especially in the early days, you need people on your board that can help you build the company. You need people around the table that don't just look for every single home run, but that want to build a portfolio of singles, doubles, triples, and home runs, the Billy Bean strategy. Because quite frankly, there's a lot of jobs that can be created through a company that's maybe a double. There's returns as a part of a portfolio strategy as a family office. There's a lot of great solutions for the world that can be created. And I think it's not a good thing to have such huge amounts of capital drive irrational growth that sometimes puts good companies out of business, and have people sitting around boards that quite frankly have no business being in the sausage making of an early stage business, and then hire all these venture partners like myself who have actually built companies and say, hey, we need people like you to come sit on our boards and help our companies. And, you know, people like me may say, why would I do all that work and get none of the economics of this fund? So I think as you're thinking about investing in funds, and in particular new funds that are out there, you know, my perspective is I would encourage family offices to look for the value add. Why is this new fund relevant? Why are these people going to generate consistent positive returns for you? Why are these partners actually skilled at building businesses, scaling businesses, and going to be in the trenches with the entrepreneur? Because things aren't always going to go well. In fact, a lot of times things are going to go badly, and you're going to need board members who have been around the block to sit there and work through those things, rather than just say, oh, hey, we're going to go put 100 million in 20 other companies and play poker.
Anybody, any of the other participants want to jump in here?
Well, one thing I might say is I've been working in this market for some time, and one of the things that I've seen is that when you have the ability to get liquidity, the market actually grows exponentially, because LPs don't want to put more money into the next fund unless they're seeing some kind of return back from the previous fund. And I think everyone probably is aware of this. 20 years ago, a company stayed private 3 to 4 years. And I've seen statistics nowadays where it says the company stays private 8 to now maybe up to 14 years. And there's been a whole revolution in the secondary market in the last 10 years, where you've gone from just selling fund stakes to now doing more structured deals to continuation funds. And now we have platforms. There was a big announcement today in the press that are trying to do sales of individual shares, from founders and early employees. One of the things that I think is going to be important to keep fueling the venture market, and maybe to Nuno's point, have a softer landing, is the ability for folks to get liquidity so that they can continue to put it back into the market. And the company that I work for is a little bit different in that instead of being a fund, it's actually a company. And they have developed a process which is based upon financial algorithms, technologies, patent pending, to be able to give liquidity to an area of the market that we haven't really touched on in this conversation. And that, there are a lot of corporate venture capitalists that have come into the market, and there's definitely non-traditional private investors like the public funds that come in. But what people, I think, are not necessarily realizing is that the ultra high net worth and the high net worth part of the market is actually growing about 3 times faster, and they're allocating a lot more of their money to alternative assets. I think the statistic is it's something like 3.2 times more of their money goes into alternatives than it goes into public equities now. So right now there's about a market size of about 40 billion, but that's going to grow more. And it's going to grow more also because, we don't have defined benefit plans that are growing, and we haven't been able to put alternatives yet into defined contribution plans. But what's going to enable that market to continue to grow is if those individuals think that they can find liquidity. So that's, I think, something to note. One of the things that has, I would say, stymied a little bit the secondary market is that usually it takes anywhere from 4 to 18 months to get a secondary deal done. There's lots of restrictions. You have to go and talk to the GP or the company. And it's very cost ineffective because you have to hire lawyers and you have to hire, do a sale and purchase documentation. And at least what we've tried to do is to do it all based within 30 days and have everything streamlined and online. So that's one thing I would say is that with any market that you're trying to grow and evolve, what I've seen actually having been involved in the secondary market on the GP side is that it's grown just exponentially in the last 20 years. But a big part of that is that you had more and more liquidity options, and it became more acceptable, and you could use it as a portfolio management tool. And because people knew they could get out, they were more willing to get in. That's my comment on that.
Thanks, Maureen. Why don't we change a little bit? Andrew, let's move to you. You brought up the topic of the day in investing, sustainability and climate. And you said to me, sustainability and climate has captured the attention of large money managers like Goldman Sachs and BlackRock, but they're not delivering on the type of growth we see in traditional consumer and enterprise software businesses. What can we expect here? And is this history repeating itself like we saw a decade ago with the first wave of clean tech companies? What do you think?
Yeah. So thanks for that. Yeah, I mean, we're seeing dozens of sort of billion-dollar plus funds, that are looking to write, $50, $100 million checks in companies, and sometimes those companies are still pre-revenue or very early revenue. And that's in contrast to, in traditional venture, those kind of rounds tend to come together for, enterprise software or consumer companies that are growing at, 25% month over month. And so it's sort of a whole different world. And, the basis of that is, we're in the midst of a transition of economies, energy transition, other areas as well. And these are huge, like $1 trillion markets, and people don't want to miss the boat. They don't want to miss the next Tesla. I think the challenges, there's going to be some winners there, and some of those funds will just on the backs of that will do really well. But I think what we're seeing is a lot of tourists. I think the term was used before. A lot of tourists that really don't understand the technologies and kind of the challenges around growth, and they're not really using that in their underwriting. And so I would expect there to be, some big sort of flameouts that we'll see with those kind of folks. So there'll be some winners, there'll be some losers for sure.
Nunu, got some thoughts here?
Yeah, I mean, it's like everything in life, and I totally agree with Andrew. If you go into a space that is extremely complex, where there have been people thinking about some of these topics for the last 20, 30 years, and you really can't, in effect, create a thesis that makes sense around it. In some ways, to the point that I made before, you are a tourist and it's going to be difficult. Maybe you get lucky, maybe you don't. At the same time, I think there is a little bit of what I would say, a sort of multi-sector or multi-functional expertise that is valuable once you're looking at these types of deals, right? So I'll give an example that's not necessarily around, climate and around sustainability, but I think makes the point, which is, for example, healthcare. We're definitely not healthcare investors, right? We have a lot of respect for a lot of great healthcare investors that are out there, like Venrock and others. That said, we are, for example, experts in consumer investing. And so sometimes we will look at deals coming from the consumer perspective and then trying to really do our homework to compensate for the lack of expertise we have in regulatory environment, in how the industry actually works, et cetera, et cetera. So for example, our second investment in our current fund is in a company, I can't announce it yet because it's still embargoed, but it's in a company that sort of brings together hardcore healthcare provisioning with consumer, right? And the reason why, for the founder of that company, we were very interesting was we bring the consumer angle. She has a bunch of healthcare investors already in there, but we bring in the consumer angle. So I think sometimes that cross-sectional view of the world brings value, and it also allows to untap for the biggest opportunities. I always make the joke that I'm not a healthcare investor, but my first investment is a unicorn in that space. I almost invested in the second investment for reasons I won't go into details. We almost invested in a company that is now also a unicorn, and this would have been my third investment. So again, sometimes it's not that you're blissfully ignorant. That's not the point. It's that bringing the angle from the other side of the table can be helpful, because you might be less constrained about the industry dynamics and how things actually work, and then take it to the next level. Now, just to finalize on the corporate sustainability agenda, I think a lot of good steps have been made. There's a lot of things that have been said, a lot of measurements that are being put at the table. It needs to be getting deeply embedded into the economic models of return. And what I mean by that is we need to start seeing companies that are in the midst of this arena of climate change and a lot of the aspects that we're talking about today that are fundamental to our livelihoods as human beings in some ways, but we need to start seeing those economic returns. And in healthcare, for example, with some of the disruptors, we already started seeing it. We've already started seeing it in some areas of energy. So I think we're gonna see it. It's not just that we have great companies that are going to change the world, but they're going to change the world and they're going to be worth a ton of money because they're going to make a lot of money. So in some ways, I feel that will untap that part of the equation. And it's still probably early days from that standpoint, and it will take us a while to get there. But definitely that, I think, was what's going to untap that whole market.
I think, Kamuti, I think it also really depends on what we're talking about with respect to climate change or a sustainable food supply or wellness or farming or all of these things that in our fund we focus on under the bucket of smart society. Our thesis is that the rapid technological innovation that we all see applied to those problems can create incredible solutions. But those solutions, in our view, and where we invest, are still rapidly scaling, capital efficient, asset light. We're not investing in hardware. We're not investing in huge wind farms or, whatever it is. We're still investing in taking sensors, taking edge network protocols, taking the blockchain technologies to change how we as human beings live, work, consume resources. And those behavioral changes are critical to actually tackling these issues. And you can do that in a way that is early stage innovation investing with very, very high returns in a capital efficient way by applying technology. So that's really our thesis. The other point I wanted to make, and I think Nuno made a similar point, is I think, at least in my fund, where all of us are ex-operators, one of my partners has literally founded 50 businesses as a founder, board member, founding board member, first investor, executive chairman. I've founded a number myself. I think as an ex-operator, you bring a particular skill set in identifying innovation and getting it to market. I can sell ice to Eskimos. I could sell, whatever it is and help an entrepreneur with their go-to-market, regardless of what category that is. And I think that's very, very critical because a lot of these innovations are created by deeply technical people or deeply scientific people. And often these innovations fail at the go-to-market scaling phase, or at the use of capital in an efficient way, or at the branding or the communications or the consumer adoption. And I think when you have that expertise, that scaling and go-to-market expertise as a fund, and you're investing post-product market fit, you're able to help make these things a success, which is why I feel so strongly that the Wall Streetification of these investments is not a good thing for LPs or for society. I'll just give a quick example. So one of the investments that we've seeded our fund with is a sustainable protein company. It happens to be shrimp, the first protein, and the shrimp is produced by advanced hydroponics and biofuels. This is an incredible innovation in the food supply. For those of you not aware, shrimp is the largest consumed seafood in the world. It is larger than the salmon and tuna market combined. It's a $40 billion market growing at an 11% CAGR. And 92% of American shrimp is imported. Most of it touches parts of Asia. Most of it is contaminated. A lot of even the free catch has bycatch associated with it. It's a really, really, really dirty industry. I'm a big seafood person. It's the only protein I eat. I no longer eat shrimp that's not produced by our company. So not to scare you all, but this is
like plastic and Chinese.
Yeah. It goes through Hainan Island, most of it, where it's processed, and just really, you often watch Seaspiracy on Netflix and get a sense of it. But anyhow, the folks that we've invested in have been working on this innovation for many, many, many years. Some of the top scientists in hydroponics, aquaculture, and on the biofuel side, taking the bio waste from farms and fueling our facilities with that. Now, we know how to get that to market. We know how to brand high-end shrimp. We know how to sell. We know how to distribute. We know how to fund that. We know how to take a playbook of a particular closed indoor ecosystem and scale it across different locations. So now that we've come in, we've been able to bring that level of professionalism and expertise to something that could dramatically transform our food security, the sustainability of our food supply, the healthiness of it, our nutrition. And I'm definitely not a shrimp farmer. So I think that's the way to look at these investments, is they have to make economic sense from a scalability, capital efficiency, return perspective. But the stage also has to make sense, so that it's the market and scaling and go-to-market expertise as an investor that you're bringing to great, great innovators solving these problems.
Thanks. Thanks, Bryn. Yeah, I as someone who's an operator himself, I agree. I think that's kind of one of the new things that we're seeing too, is more operators being involved in the funding side. And I think that's maybe going to be the value add that can change where you take money, considering there's a lot of money out there and people have a lot of choices of where they want to go. Before we kind of try to wrap up things, I'd like to just go around quickly, starting with Maureen, with about trends for 2021. But let's go a little bit farther and talk about what we see 2022 looking like for VC. If you had to, share 1, 2, or 3 kind of different things that you kind of look in your crystal ball and see happening as a result of some of these trends, what would you share with the group?
Well, I see, assuming that the current equity markets stay on the same trajectory, maybe not as high growth, but they stay going in a positive direction and interest rates continue to be restrained, I can see the market continuing in terms of being positive and people deploying more and more capital. I do anticipate with more capital coming into the market that there is going to be more and more pressure for folks to get liquidity in different ways, just because people will want to raise new funds. As many people here on this call probably know, many people are, basically compensated with options or shares in private companies. So I see that given we have stability in the economy and the stock market continues to perform, you're going to continue to have more money coming into the venture space, which is also going to basically push for more answers for liquidity. So I'll leave it at that.
Thanks. Andrew, why don't you share with us what you think?
Yeah, so I mean, one of the topics sort of within the financial industry as a whole, including venture, has sort of been, diversity, equity, and inclusion. You know, our view on is the most successful firms in venture thought about this long ago without even sort of thinking about it or you know, really institutionalizing it. It was just sort of embedded in kind of their thought process, and they recognized that that was just an important part of making the best decisions. You know, that's certainly how we've always thought about it, but now we're sort of seeing this institutionalizing of that, and I think that's gonna, you know, the venture industry has long been, you know, guilty of decision biases, groupthink, that kind of thing, and I think that's negatively impacted outcomes in some cases. And so, you know, as we see sort of a increased emphasis on this topic, I think that should change the industry for the better, you know, over the coming decade.
Maybe one thing I'll comment on that, Andrew, and call me an experienced optimist or experienced, yeah. I think we do great, and we say a lot of great things about diversity and in times when we're in an economic upswing, but when we go into the economic downswing, it kind of goes away, and that's just been my experience. I hope what you're saying is true, because I do think whether you're talking about diversity of gender or diversity of ethnicity or frankly diversity of age, you do get a much better decision output when you have a diverse group around the table. I just hope that the sentiment can be sustained through an economic downturn.
I would just also throw out there that we still only have 4% of general partners who are female. It actually went down last year despite all of the dialogue. So we still have a long way to go despite all of the rhetoric.
Bryn,
I have a question, guys. Can I just give you a question? So I know you guys just described venture capital as kind of being like Venice, overrun with tourists, right? But so, you know, to me, there's a lot of places that are unscathed by venture capital, and like Mark Andreessen talks a lot about on the podcast of Anderson Horowitz about, you know, spaces like education. Christian was talking earlier about you know, this financial bureaucracy, et cetera. And can you talk about areas where you see that still exists? Because I see venture hasn't really played out much, right? It's not highly innovative in a lot of ways. So you know, if bureaucracy went away, I mean, I could see education changing dramatically, right? I mean, I wouldn't do education the way people do it now. Any thoughts?
I think there's, to your point, Marty, there's a lot of areas that are not well looked at from venture capitalists. Some of it actually is, shockingly enough, not because of industry, but because of founding team, where they're located, et cetera, and that creates a bunch of biases. A lot of VC firms treat most of their flow inbound, so they're looking at their, let's call them proprietary networks, so to speak, and therefore, if you have an approach that is more outbound, where you actually are looking at the market all the time and trying to generate deal flow, hopefully that deal flow will be less biased and you'll find more interesting companies out there. The second piece that I think is really interesting is there are areas that actually there's a lot of investment from venture capital, but sometimes it's maybe not the right investment. And so, for example, InsurTech, we just spent maybe the last 3 months looking at a lot of InsurTech plays. Everyone likes the shiny object of disruptors. Everyone likes the shiny object of a company that comes in, for example, and totally disrupts a specific area of insurance. Now, as you've seen, that's really difficult to do. It's normally very capital intensive. And in some cases, it fails miserably. I mean, if we go back to the Zenefits example and what they were doing around replacing brokers and how they were doing their certification, all of that, we've seen there's some bad things sometimes when you're too disruptive, let's call it. So actually, sometimes I feel that our industry is not good enough at looking at the opportunities that lie within the current architecture. Not the disruptors, but the guys that can fit into what exists today and can actually have a state there. They can replace the legacy providers, they can add to the legacy providers and can help that industry actually become better and more efficient. So for me, that's a really strong a view of what that is. I did want to react to Bryn's point. She made it earlier, you know, only 4% of all GPs are women. And I think that is a very important point. We have 2 managing partners at Chamaeleon. One of those managing partners is me. The other managing partner is a woman, and she's been, you know, someone I've worked with for the last 14 years and someone that honestly, I wouldn't have done this if it weren't for her. So she was the propeller of, you know, the creation of Chamaeleon. I do think there's a tremendous lack of diversity in venture capital that goes well beyond women and men. Latinx, probably the most underrepresented community in the startup world that gets funded by venture capitalists. In some ways, even probably worse than the African American community. There's a lot of work to be done across the board. One of the things that I keep coming back to, and this is not my pitch, it's not my vertical, I truly believe in this, is if we're going to disrupt venture capital and picking, let's at least make it more unbiased. And there are tremendous advantages to us, which are not just the fact that we're working with more African Americans, Latinx, and female founders. There's a tremendous advantage to that, which is we actually are looking at better companies. We see more companies. So again, I think that's an effort that we as an industry need to actually undergo more significantly than we have until today. Be more unbiased on top of funnel deal flow.
I also wanted to respond to Marty's comment because I thought it was a really good one. And a little bit to Nuno's as well. I think there's historically been a lot of similarities among GPs, and that's just not gender, race. It's also background and location. One of the beautiful things about COVID is we've all learned that innovation can come from anywhere. And maybe the people that are best suited to solve a problem like tackling wildfires actually live in a place where they face the highest wildfire risk, don't actually live in central San Francisco, as an example. And so I think that's a really, really important trend. When we built our fund, we consciously have 2 partners who are European, 2 partners who are American. We look for the best deals with the best economics within our investment areas across Northern Europe and the US. But crucially, every single one of the 4 of us has had a pretty significant career in both a country in Europe and in the US. And we look for arbitrage opportunities as well in sectors that might not necessarily be top of mind in the historical VC model. A good example, again, is the shrimp business. So in Oslo, seafood companies, innovative seafood companies on the Oslo Stock Exchange trade at multiples like SaaS businesses do on NASDAQ. These businesses are listing at 25 times revenue with under $1 million of revenue. I mean, it's a crazy, crazy market for aquaculture and seafood. So we can find those innovators in America. This business actually, oddly enough, shrimp business happens to be founded in rural Montana. So we went there. It's a 5-hour drive from Bozeman. So we got in a car, drove from Bozeman numerous times to visit the business. One of my partners is Norwegian, so understands the arbitrage opportunity here from an exit and return perspective. That's not your straight down the fairway. Everyone was a tech founder living in San Francisco and came together to build a fund, or everyone worked at Goldman and came together to build a fund in Manhattan sort of investment. But it's an investment that is going to be a massive company that transforms the world and delivers a great return to the fund and our LPs. So I think it's more about putting together partner teams, Marty, that have different perspectives and are willing to go into different industries and have a playbook and find the entrepreneurs with those innovations to transform them, but also deliver kick-ass returns.
Yeah. And I'll add one last bit of practical advice for everyone who is investing, which ties in with the question that was originally asked, which is the big megatrend we also see is that investing is going global. And we're about to have completed our 4th investment out of this fund. And of those 4 investments, 2 of them are here in the United States, one in Silicon Valley, one elsewhere, but then one is in Brazil and one is in the UK. And remember, our model is we are co-investing with the top VCs. So in Brazil, Founders Fund is involved. In the UK, Lightspeed and General Catalyst are involved. And so I think that it's very important, just as you're looking for your own direct investments and your fund investments, to think about the fact that now that we have really collapsed geography with Zoom and the pandemic, there is more activity going on around the world than ever before.